Thanks for joining us for this month's market update. I'm joined today by Casey Lowe, Senior Consultant, Frontier Advisors, Capital Markets and Asset Allocation Team. Hi Casey.
Wayne.
So US growth has been strong of late despite the trade tensions we've been hearing so much about. Talk us through that.
That's right. So despite the trade tension, US growth has been strong. You look at the latest economic data release for the June quarter. On an annualized basis, the US did 4.1%, so very strong numbers there. Now there's been a few drivers for this. So first of all, fiscal stimulus from the government, policy reform, and also the trade issue itself has actually been positive for the latest growth numbers. So there's been an increase in pre-purchases of US products from China, such as soybeans, which have actually contributed to growth in the recent quarter. So over long term, maybe trade tensions would have a negative impact, but at the very short term, it has contributed to growth. Look at elsewhere, the employment market, the unemployment rate's at 3.9%, so very low, very strong numbers there. Look at corporate earnings, the latest reporting season have also shown very strong earnings results as well, so all around quite strong for the US. Now what does this mean for the rest of the world? So strong US growth should flow through to strong global growth as well.
So focusing in on the rest of the world, still on the theme of trade tension, talk to us about China.
Yes. So China has been responding to the trade tension in the US. They have been retaliating, putting on their own trade tariffs against the US. And if you look at the domestic economy, it looks like it has been slowing down over the last couple of quarters. You look at investment spending, that has come off, particularly infrastructure spending. If you look at credit growth, that has also slowed down. But if you look at the details of it, most of that slowdown has been coming from the shadow banking sector, not so much from the traditional banking lending sector. And when I'm talking about shadow banking, I'm talking about the lending that occurs outside the traditional banking system. So these are loans that are unregulated and also tend to be more risky. And so that has started to slow down, which is in a way a good thing because that's what the Chinese government is targeting to reduce. So China has been slowing down, and what we're seeing is that it's slowed down enough for the government to respond to it. So in recent weeks, the People's Bank of China, which is the central bank of China, have come out with policies to ease their monetary policies. And if you look at the Chinese government, they've also come out with announcements to encourage investment spending. So Chinese growth is slowing, but the government is stepping in and responding to it.
Sure. So let's return to Australia, and in particular the property market. There have been some negative signals there just of late. What sort of things are your team looking at?
So the property market in Australia is important, and we do spend a lot of time looking at it just because it's a big part of the Australian economy.
Yes.
So some of the stuff we've looked at, we've looked at the house price growth at the aggregate level. That has started to slow down. You look at the cities, the capital cities level, those have also slowed down. In particular, look at Sydney. So they are marginally negative on an annualized basis. So prices are slowing down. Some of the other measures we've looked at include new loans being issued. So that has also slowed. But if you look at the underlying numbers there, it's really coming from the investor loans. Investor loans have come straight off, while loans to owner-occupiers have actually come off a tiny bit, but still quite steady. Now, why is house prices slowing down, and why are loans coming off? So a lot of this has been driven by the macroprudential policies put in place by regulators such as APRA on the major banks, which have seen their credit standards start to tighten. So that's been one of the key drivers. Looking forward, some of the measures that we look at, the time to buy survey from the NAB surveys, and also the number of transactions, house transactions, sales transactions that takes place. So those measures tells us that house prices are likely to continue to slow over the next 6 to 12 months.
Sure. Thanks, Casey. Plenty to think about. Thanks for joining us for this month's market update.